Hi, this is Brian Resney, President of Resney Wealth Management. I'm here to bring an important update about the economy and the investment market so you can better your financial position. You know, it's interesting. I'm looking at the markets and we're seeing a little bit of a sell-off going to happen this morning, basically because of large cap Cisco Systems, a stock that's in the router and the internet business. Here's a stock that basically I've talked about probably a half a dozen times in the last year on my radio show, not only from Radio Questions, but just in general about large cap investing. One of the most important things investors need to realize is investments that you may have bought 5 years ago or 10 years ago, or investments that worked 5 or 10 years ago or 20 years ago for that matter, may not be appropriate today. I've repeatedly talked about large cap companies, big multinational companies that everybody hears about. Often these are the exact investments you do not want to own. Again, what did well in the past may not do well in the future. I think so many investors have a tendency to buy what they're familiar with. Cisco Systems is one of those household names if you're an investor and you get involved in the investment field at all. And unfortunately, here's a very mature company in a very, in my opinion, tight space, meaning there's other competitors. Technology is changing over time, and unfortunately when you are the 800-pound gorilla and you want to grow your business, it becomes very, very difficult to do so just because of the law of large numbers. Now, does that mean every large cap company should be sold and you should run away? No, there's oftentimes a value within some of these companies, but what happens is investors will often be lulled into kind of that false sense of security because it's a household name and because the price used to be, let's say, $80 a share and now it's trading at $20 a share. They perceive that to be cheap. Share price itself has nothing to do with valuation. You can have a stock that goes from $80 down to $20 and it can still be grossly overvalued, as we saw in a lot of the internet companies back in 2000. What you're looking at, bottom line, is this. You're looking at things like book value, tangible value of the company if you were to liquidate that company. You're looking at discounted future cash flow in this company. You could be looking at dividend streams. You could be looking at price to sales ratio, price to growth, or a combination of the two. I believe investors need to make sure you understand when you're buying individual stocks, especially, that you understand share price has nothing to do with whether or not a stock is cheap on valuation basis. Again, an $80 stock that drops down to $20 or even $5 does not mean it's cheap. You need to look under the hood and do your comparisons and do your metrics to figure out if that stock is really an opportunity. Stocks that are $20 could go down to zero. Stocks that are $80 could go up to $150 or $200 or $300. So really, share price has nothing to do with it. Make sure you're not buying investments based upon because you've heard of the name or it's a household name. And make sure before you actually buy any investment that you do your own proper research unless you are actually using a money manager who is doing that for you. Make sure before you buy that investment you also have a disciplined sell strategy on when you plan on selling a particular investment. I'm going to talk about one specific stock today, and by the way, fair disclosure, our firm does own this stock. We actually bought it about 2.5 years ago, and it was the New York Stock Exchange, the NYX. In fact, last night there was announcements that they are in merger talks with another major exchange to be sold. Now that's great for our shareholders because we were already seeing a 15% premium in share price on this particular stock. What my goal probably is, I'm going to watch today, I'm going to read some more of the headline news and some of the details, and chances are I'll probably end up selling that stock. But here's a company, and the reason we bought this company about 2.5 years ago, it used to be an $80+ stock, but at that price it was grossly overvalued. But we watched this stock for a long time. When the credit boom and bust happened back in 2008, this stock promptly dropped down to around $10 to $12 a share. We actually started picking up shares around $18 to $19 because of the high dividend that it had, which was close to about a 6.5–7% dividend stream. The share price now is trading kind of north of $37, $38. I want to see what kind of price target the NYX is going to be bought out at today, and at that point I will probably end up selling our position either today or sometime before the end of the week. Bottom line is this. The reason we bought NYX, it was actually cheap based upon a valuation basic 2.5 years ago. Dividend looked excellent in our opinion, and the biggest thing, it really had a catalyst for that company to grow when it was trading at $10 and $12 a share. So we bought it based upon valuation and doing some research and really looking at what was the catalyst to make this stock come back. Now, we didn't think it was going to go back to $80 as it was grossly overvalued at that price tag, but we did feel that this stock could easily double over the next 2 or 3 or 4 years if we were patient investors. What was nice about that, buying at $18 to $19, selling something around $40, you've doubled your money in basically about 2.5 times. Not a bad return. Does that happen with every investment? No. But again, if you have a disciplined buy strategy and a disciplined sell strategy, I think you can be a much smarter investor. Again, the New York Stock Exchange NYX is not a household name for most investors, but it ended up being a great opportunity for our clients. Remember, if you buy something, have a reason why you're buying it, true research, and at the same time have built into your equation when you plan on selling it, because either A, the investment thesis is changing, or it's hit fair value and it's time to lock in a profit and move on to better pastures. This is Brian Resney with the Resney Wealth Report. Make sure you do listen to my show this Sunday from 10 to noon. And as always, if you're finding that your money is not actually being managed and you'd like to talk to our firm about managing your retirement portfolio in a manner that's right for you without the conflicts of Wall Street, call my office. We'd be more than happy to set up an appointment to talk about your portfolio. Again, Resney Wealth Management does manage larger investment portfolios of $500,000 and up. Call us. We'd love to help get your portfolio back on track and make sure you have yourself an extremely profitable day.